Hello and welcome to another special edition of Go Fish Village podcast. I'm your host, founder of Go Fish Village, Joshua Mercer. If you're looking for a realtor, please get at me. I'm with Premier Chicago Real Estate. But today we got a special guest. We got some lenders. Hard money, that's a term that's often used. And, sometimes it got negative and positive connotations depending on who's talking about it. But I got Brendon Harrington here from Constructive Loans. Real good dude, assistant vice president, Truman State. He's got extensive experience in the loan game with such companies as HSBC, also Chase Bank. But what I like about Brandon is that he's committed to helping lenders, not lenders, but investors reach their financial goals, and that's really what we want to talk about today. You know, is hard money and just talk about Brandon's experience. So, Brandon, when you hear the word hard money, as somebody that's been in the game, what immediately comes to mind?
Well, hard money. So everybody, takes that term literal, like, oh, it's hard money. It's going to be hard to get. Well, it's actually very much the opposite. Hard money really just goes to refer to asset-based lending. Um, what people don't realize is that majority of the loans that we're used to hearing about are backed by either government agencies or just the normal loan agencies period, where you have to go through all of their, I don't want to call it red tape, but their underwriting guidelines, and you have to be able to to qualify based on all of their rules, right? They have their own playbook, and then those loans are ultimately backed by those agencies. Well, hard money loans actually can be a lot easier to get. What it is, though, is, again, it's an asset-based loan. So what a hard money lender is going to really look at is the actual overall deal. Does it make sense on the front end? Do you have what you need going into it to make it, less risky for the lender? And then are you going to make your profit on the back end? And that's really what's most important, the profit on the back end for a hard money lender.
Okay. So before this, you were with HSBC and Chase, correct?
Third.
So that was a lot different in terms of the products that you offered then and now. Can you just shed some light on what products maybe a Chase Bank or your more well-branded banking institutions might have versus lenders like yourself?
Absolutely. So if you go into any normal bank, you're going to be, if and you're looking to apply for a loan, you're going to basically be applying for, probably two or three different products, right? They're going to look at you for your typical FHA loan, your loan, which is backed by the Federal Housing Administration. And then they're going to look at the agency loans, your conventional loans, like your Fannie and your Freddie loans, right? And then with all of those loans, what the average consumer doesn't realize is there's like 1,000-page guideline book for all of those products, whether it's FHA or Fannie or Freddie, right? And the most important thing, if what it all really boils down to, is, do you have the personal income needed to support the loan that you're going to get? Are you going to be able to make your payments on time? Do you have the credit scores that they're looking for? Do you have the money in reserve that they're looking for? Can you show it in your bank account? Have you been on your job for 2 years? Have you had any delinquencies in your credit, like any late payments, any collections? Have you gotten any public records like foreclosures or bankruptcies? All of those things are going to be considered. And a lot of those things, if you don't meet, if you don't fit into their box, that can really, excuse me, that can really mean a hard stop for you as far as getting one of those loans. Whereas, if you come to a lender like me, what we're going to do is we're going to hinge a lot of what we do off of the actual appraisal on the property. So, for example, we do short-term lending for both, for fix and flip or rehab properties. And then we also do long-term rental lending. Before we even get started and offer you an approval on a loan, we're sending out an appraiser to determine that if you're doing a flip, that you're going to be able to sell that property for a profit at the end, because it's going to be a short-term loan. We're expecting that you're going to get into the property and rehab it very quickly and then get it on the market to sell it. Or if you're doing a rental loan, what we're going to do with our appraisal is actually order something called a rent schedule, because we want to make sure that market rents in the area are going to be enough for you to generate a cash flow and make payments on your loan every month. So those are like very simplified versions of what you're going to see if you were to walk into a bank as opposed to coming to a hard money lender like myself.
So why do and thanks for the explanation too. That was a great breakdown. Why who is your ideal customer that would come to Constructive or come and get hard money as opposed to going to the traditional bank?
So our ideal customer is going to be someone that has decent credit. It doesn't have to be the best credit, but of course we don't want anybody that's just, having a track record of just not paying their bills at all, right? But someone with decent credit. Then we also want to have someone with some financial stability, some just assets actually. Someone, if they want to work with us, they actually need to be able to have, I would say at least, to get started, at least about $25,000 to $30,000, and that's just reserve funds just in case you need to, to back your project up.
So it's
But
assets more so than income.
absolutely, we don't even care if you have a job. You don't need to send me a pay stub, a W-2. Yeah, you can show losses on your taxes. Those are all things that are going to be a
That's
hard stop at a
my kind of lender.
yeah. Those things will be a hard stop with a normal bank, but not with us.
Okay.
We're looking at the deal. We're looking at the specifics of the deal, and that you have halfway decent credit and just a little money to get you going.
So decent credit would be what? Like what
Right now,
range?
right now we actually have programs that will lend on with credit as low as 620.
Okay. Credit. So I mean, if you're out there watching, you should be taking notes on especially hard money lenders. So we're talking about try to get a credit score of 620. Try to get, and assets. And can you just define like what type of assets we're talking about? We're not talking about an asset like my car is worth 15 grand, right?
Question. We are not. We are not. So right now, things that we can qualify as assets are things that basically you can make liquid. So of course, money in the bank is going to work. Retirement accounts will actually qualify, things like an IRA or a 401k.
Mm-hmm.
Cash value life insurance, if you have that. Stocks, bonds, and mutual funds, or any investments vehicles like those we can use. And then even if you have a home equity line of credit on your primary residence, we can actually leverage that as well. So whatever you have available there, we can count, some of it as cash.
Nice. So okay. So we talked about two requirements. One was assets, another was credit. Any other requirements?
So one that's not necessarily a requirement, but it's definitely a plus, is if you do already have some experience.
Okay.
So the a good example would be someone who, bought a home as a single person, got married, decided to, get a new home with their spouse, but they kept the original residence that they had as a rental property. Well, that is an ideal candidate that now has some level of experience as a landlord or an investment property holder. And now that's going to help qualify them for better terms with a hard money lender, because they already know what it means to be a real estate investor.
Got you. So, and question: do you do loans all over the country or just Illinois?
We are a nationwide lender. We lend in 45 states right now.
Okay, 45 states. All right. So, what about interest rates? Now, I know that from my experience, the hard money lenders have a bit of a higher interest rate. Right now you can go to like a traditional lender. And when I say traditional lender, I'm just referring to like a Chase Bank or a Bank of America, someplace like that. And you get an interest rate around 3%. What can we expect with Constructive?
You are not going to get 3% with Constructive or any hard money lender.
Okay. Okay.
So what you have to realize is one of the reasons that hard money lenders exist is because they're willing to take risks that banks aren't willing to take. And in order to work with a lender that's going to take those risks, you're going to have to pay for it. So
Absolutely.
the what's important to know though is that the rates, while they are higher, generally the payments are still very affordable,
Hmm.
especially for the deal. And then also you have to consider the fact that if you're doing something like a rehab, it's a short-term deal only. So you might have a higher interest rate, but you're only going to be making the payments on it for at most 6 to 12 months in many cases. And then a lot of times we arrange for the payments to be interest only. So the rates are higher, but that doesn't necessarily mean that the deal doesn't work.
Okay. So, and that's good to point out. So it goes back to that experience piece, and that investor component. This is you guys aren't going after the first time home buyer. You're going after somebody that, hey, I've done this before. I have a plan. I know what I'm going to do. I got a team, and I have an exit strategy.
Exit strategy is definitely important. Although I will say we will work with newer investors. It is kind of important for you to have owned your own home to kind of understand the process, but it's not a deal breaker if you don't.
Okay. All right. No, that's all really good information. So let's talk about ARV.
Okay.
I think that's a big component as well in terms of, because when I go to a lender, when I think of hard money lender, that means if I'm gonna have a partnership with you guys, that means that I have to make my money as soon as I get the loan from you guys. It's not when I sell it, because when I come to you all, it's ARV, which stand, after repair value. Can you just explain why that's so important to uh hard money lenders?
Again, it aligns with the risk. We want to make sure that you have a solid exit strategy, like you mentioned earlier. So after repair value is going to be key for a renovation deal. So number one, we will only lend up to a maximum of 75% ARV anyway. So you're never going to be in a position where we're going to, jeopardize that exit strategy. We want to
Mhm.
leave that buffer there or that cushion there so that as soon as you finish up with a project, you'll be able to either sell it quickly or refinance it and keep it as a rental property and do
So
that
if I
fairly.
come to you guys, the most that you'll loan is 75% of ARV.
Yep.
And I think for people got to realize that's important, because if the deal goes bad, Constructive has to be able to recoup their money easily, right?
Absolutely.
Yeah.
Absolutely. You're on the hook for a loan. It is a mortgage on the property. So
Hmm.
you have to be able to pay that back quickly.
But that kind of protects the not only the lender, but to me, I feel like it protects me, because if I do get out of the loan, I know that this place got at least a certain amount of equity, so you guys won't be coming after my t-shirt, my pants, and everything else.
Absolutely, absolutely. Well, I mean, like I said, it's when getting into this is all about a numbers game anyway. You want to make sure that you set yourself up to be in a profitable deal, and having a solid ARV is the way to do that. And like I said, we when we get started in the beginning with the application process, the appraisal is going to tell us that from Jump Street. So
Mm,
we'll know exactly what we're getting into. The borrower will know what you're getting into, and everything just hopefully runs smoothly from there on.
okay. And so just to reemphasize, so ARV, if I'm getting this right, so it's after repair value. I find a property that's $100,000. I say, hey, Brandon, I want to buy this property with you guys. I'm gonna put 50 into it. When it's all said and done, it's gonna be worth about 400 grand. That's kind of the deal that you guys would finance, right?
Absolutely.
Yeah.
Absolutely. Yeah, that deal is going to have what we like to call meat on the bones. So yeah, you'll definitely walk away from that deal as a happy camper.
Yeah.
And that's a deal we feel comfortable lending on because the equity is going to be there after you repair it. Correct.
Hmm. And like any bank, you guys are making it. You guys make your money once those documents are signed, because you're getting paid off for the interest in the beginning. So as a client, you know, it's important. So what I like about the ARV, it forces you to find a great deal. If you can find a great deal, you can get the financing, especially if you had the assets and, like you said, and you're somewhat experienced.
And we don't, but there are lenders that will lend to you specific, just off of ARV.
Mm,
A lot of times their rates are higher, even higher than what we offer,
yeah.
and their fees are higher as well. But in the cases where you might actually be light on assets, that's a good thing for people to know as well. There are actually some lenders that will work with you, even if you don't have assets, they'll work just off of ARV.
Okay. So let's talk a little bit about exit strategy.
Okay.
So with you guys, I mean, I know you probably had some customers where it is a long-term relationship where they are cool with going with a 30-year mortgage or whatever. But would it be fair to say that a lot of people that you work with, after you lend them money, they're gonna refinance probably within 5 years of the deal?
Absolutely. So if especially if someone's doing a rehab deal,
Hmm.
if they a lot of people get into this wanting to build a rental portfolio, but they just happen to run across properties that need some TLC. So those are borrowers that will actually start off with us doing a short-term rehab loan. And then once the property has been stabilized, once they repair it, they'll turn right around immediately and refinance it with us into a 30-year mortgage.
How soon can you refinance?
So generally, the rule of thumb is 6 months of ownership. Once you've owned the property for 6 months, you are able to refinance it using the after repair value.
Okay. And so when you say stabilized, for people that may not know, what does that mean?
So stabilized would be that you've repaired the property, you've
Hmm.
taken care of all of the issues, gotten it up to fair market value, and then you've put a tenant in there.
Okay. That does it have to be 100% occupied?
Not in the case of multifamily properties, it doesn't have to be 100% occupied. We just have to make sure that the rents received on the property, whether it's by a few of the units or all of the units, are enough to cover the payments on the loan.
Okay. Okay. And prepayment penalties.
Sure.
I think that's something that people got to understand, that's common no matter where you go and get money from if you're doing a commercial deal. How do prepayment penalties work?
Generally, on our loans, we do have at least a 3-year prepayment penalty. In some cases, we'll offer a 5-year prepayment penalty for a discount. But generally, the lender wants to see those books, the long-term deals, so rental loans, they want to keep those on the books for a few years. So generally, we'll have a 3-year prepayment penalty, where it doesn't mean you can't pay the loan off, but you are going to pay a fee
Hmm.
at if you do that within the first 3 years. Our fees actually are set up to be reducing. So as you go along, it reduces. It's a right now our typical prepayment penalty is a 3-2-1 prepay, where you'll pay 3% the first year, 2% the second year, and 1% the third year.
and
And
that
then
and
after that, no pay.
Okay, and that percentage is based on the outstanding balance of the loan.
Actually, it's based on the origination balance, the
Oh,
original
okay.
loan balance. Mhm.
Okay. Okay. So your rental loans that you do, are those required 25% down as well?
Right now we have one product that allows you to get into a single family rental with as low as 20% down.
Okay. Okay.
Mhm.
Dope, man. So can you shed some light on, you know, uh how you've, like, maybe a person that's come to you for more than one deal to help build a portfolio, and how
Absolutely.
you've helped customers reach their financial goals?
Absolutely. Absolutely. So I have a few customers that came to me with no experience. We have an excellent flip program that allows you to get into the game without having any experience at all. So, the good thing was in this person's situation, they were actually able to partner on a deal with his dad. He partnered with his dad. Um, he basically is the workhorse, but his dad
The
um,
money
actually,
guy.
yeah, he had a big retirement. He
Yeah.
had a big retirement set aside. So we were actually able to put him on a loan application as co-borrowers using the dad's assets. We got the son started doing flips. And again, he came to us a year ago with virtually no experience, and now he's up to like maybe 6 or 7 flips that he's done that have all been financed through us. And
Wow.
a few of those, he instead of selling them, he actually refinanced them. Well, he kept them as rental properties, and so now he's seen his bank balances go from minimal to to outstanding now, and he's just going full speed ahead right now, taking on bigger and bigger projects as well.
Oh, that's dope, man. From zero to hero. So that's important to have that backing. So again, we're talking about asset based lending. So if I come to you, let's say I've been on the job 6 months, but I got 100 grand. in my bank account. My credit is 650 ish. What can I expect to be able to borrow from you guys?
So right now with that scenario, if you don't have any rental property or any experience, right? If you're brand new, you'll have to put a 25% down payment down.
Okay.
But on a rental property, you can get right into a property that's ready to go with that 25% down payment. And as long as the rents received on that property cover the payments and generate a little bit of cash flow for you monthly, you'll be fine on the rental property. We'll approve that. And then if you want to do a rehab, that same 25% down, that's what you'll use to purchase the property. But we'll also cover a rehab budget for you as well.
How much of the rehab budget?
We'll cover 100% of the rehab
100%.
up to 75% of the after repair value.
I love it, man. And I love the fact that you guys, you do the appraisal. So the appraisal is like, hey, we business partners. So let's see what let's see what this asset is really worth to see if you really got a deal. Now, is that appraisal free?
It is not free. It is not free. That's a good question. Right now, you can expect to pay for these types of appraisals as well. You can expect to pay anywhere between $600 and $700 in most cases.
Okay. And to be open, I've paid for many appraisals and not moved forward with deals just based off of the appraisals I paid for home inspections as well, and not move forward just because I didn't like what I saw. Because when you get into these real estate deals, you got to know what you're doing because you're paying a lot in interest, and then labor costs, overhead, all of those things add up, you know. So no, that's dope, man. Do you have any examples of a person that was a developer and you know was doing a buy and hold strategy with you guys?
Absolutely, absolutely. So, had a great deal out of Cincinnati actually, where a group of investors got together and they actually went in on a 27 unit apartment complex that
Wow.
they actually rehabbed and then refinanced and kept as a rental property. So
Mm.
this was a kind of like a team situation where everybody pulled their resources together and went after something larger.
Wow, 27 units. So what's the most that you guys will lend?
So right now, the things are a little different because of the whole pandemic situation. But we've had products in the recent past that allowed us to finance up to 50 units. But
Wow.
right now we're staying in the 1 to 4 family space.
Oh, okay.
Yeah,
Okay. Okay. So once things probably open back up and you know, it gets back to normal, you'll be able to do those bigger projects again.
absolutely.
No, that's dope, man. That's dope. So, um, do you ever have a scenario where somebody may come to you and you say, you know what, I think, I think you'll be better served going to X, Y, and Z institution.
Absolutely. So a lot of times people come to us wanting to do rental loans. And it may be their first, one or two, or heck, even 10 investment properties. We are not the lender, and we don't have the best situation for someone who is actually just getting started as a rental property owner, specifically rental property. I mean,
Mm-hmm.
not something that needs a bunch of rehab, but just rental properties. If you're looking for something that's already in rent ready condition, that's pretty well stabilized, and it's a 1 to 4 family product, if your personal income is in order, right, and you have the credit and you have the assets, you would be much better served by going to a traditional bank and getting a Fannie or Freddie loan, because you can get those at today's interest rates with, you're probably still going to need about 20% down, but you'll get a much better loan from a normal bank in that situation. Now, the moment things don't add up with your tax returns, the moment
They'll be back.
yeah, the moment you don't meet one of the bank's guidelines, yeah, you'll probably find yourself back with constructive loans or a hard money lender. But a great example, right? I always think of specific customers that I've worked with in the past, right? I've had a doctor come to me like, hey, I'm thinking about retiring soon. I want to do some things to maybe create some cash flow. So I want to buy some investment property. Well, the from the on the surface of things, it looked like everything was great for him because he had tons of income, right? And then he went to the bank. I said, okay, this is going to be a lot better for you if you actually go to a bank. Well, what ended up happening though, me not knowing because I hadn't pulled his credit just yet, was that he had tons of income, but also tons of debt.
Mm,
I've had people that have had to come back to me because things like student loans took them out of the box of a bank.
wow.
So, so
What
yeah,
what's like the typical turnaround time of somebody coming to you and you giving them like a pre-approval and then they getting funded?
most hard money lenders can fund deals anywhere between 2 to 4 weeks. Right now, we're running about 3 to 4 weeks to fund a deal. And
Wow.
honestly, a lot of the slowdown is because of there's a refi boom in the traditional space where everybody's taking advantage of the low interest rates. So a lot of the appraisers are backed up right now.
Wow, man. So man, that's interesting. If if I have a flip strategy or that buy, rehab, rent and refinance strategy, is that something that I could do with you guys?
Absolutely,
Okay.
absolutely.
Okay.
So yeah, again, you start off with a fix and flip loan. You get a property that needs some TLC. You get out there, you rehab it. Make sure that ARV is good so that you can get the funds to rehab it. Once it is stabilized, get a tenant in there. Then call us back. We'll refinance it for you. Even give you some cash out on the new ARV. You can use that as a down payment on your next one.
Oh man. So what so if somebody wants to get in touch with you, man, how do they do that?
Absolutely. They can reach out to me directly at my office line. It's 312-291-3734. That's 312-291-3734. Or they can send me an email actually at bharrington@constructiveloans.com.
Thanks, B man. I appreciate you coming on the show. Again, this is the Go Fish Village podcast where we help educate people on how to use real estate to create wealth. If you're interested in or need a realtor, please contact me. I can be reached at www.listwithmercer.com, or you can hit me on my cell 773-426-1626. Brandon, man, I appreciate your time.
Absolutely. My pleasure, man. Thanks for having me.